Silver just crashed, and traders are seriously confused right now. Because while silver was dropping hard in US trading, gold was doing the exact opposite, pushing higher and holding strength. And when major financial outlets started pointing out what's really behind gold's rally, it made this silver move even more suspicious. So what just happened? Is this the beginning of a deeper silver correction? Or is this one of those classic shakeouts before a massive move higher? Let's break this down carefully, because this is one of those moments where understanding the why behind the move matters more than the move itself. As of today's session, silver prices pulled back aggressively after failing to hold a key short-term support zone. The selling accelerated quickly, and that tells us something important. This wasn't slow distribution. This looked like triggered stops in algorithmic momentum selling, especially in the futures market. Meanwhile, gold held firm. In fact, gold has been pushing higher on renewed safe haven demand, geopolitical tension, and growing uncertainty around monetary policy. And when financial media began highlighting that gold's rally may reflect deeper systemic concerns, not just headline risk, that's when traders started asking, if gold is rallying for structural reasons, why is silver falling? Historically, gold and silver move together. They don't always move at the same speed, but correlation is usually strong. When gold breaks out, silver typically follows, and often outperforms later in the cycle because it's more volatile. So today's divergence stands out. Now here's the first thing you need to understand. Silver is not just a precious metal. It's also an industrial metal. Roughly half of silver demand globally comes from industrial applications: solar energy, electronics, EV components, advanced circuitry. That makes silver sensitive not just to inflation and monetary fear, but also to growth expectations. Gold is primarily a monetary hedge. Silver is both a hedge and a growth asset. And right now, those two narratives are clashing. Gold is benefiting from safe haven flows. Investors are hedging geopolitical risk. They're hedging currency concerns. They're hedging policy uncertainty from the Federal Reserve. That supports gold directly. But silver also trades based on expectations for industrial demand. If markets are pricing in slower growth, tighter liquidity, or economic fragility, industrial metals can struggle, even when gold rises. So part of today's drop may be macro positioning rather than weakness in silver's long-term fundamentals. But there's another layer. The silver futures market, especially contracts traded on COMEX through the CME group, is thinner and more leveraged than gold. That means when technical levels break, price moves can get exaggerated very quickly. And that's exactly what we saw. Silver attempted to hold support. It failed. Stops were triggered. Momentum traders stepped in, algorithms detected breakdown signals, and the move accelerated. When markets move fast like that, it doesn't always mean the fundamentals changed. It often means positioning changed. Now let's zoom out. Over the past year, silver has experienced extreme volatility, massive rallies, sharp corrections, fast rebounds. This is not unusual for silver. In fact, silver historically shakes out weak hands before big trend moves. The question now is, was this drop distribution, meaning large players exiting, or was it a liquidity flush before accumulation? To answer that, we need to watch what happens next. If silver stabilizes quickly and reclaims the broken support zone, this drop could turn into a classic bear trap. That scenario would likely fuel a sharp upside move, especially if gold continues climbing. If silver fails to reclaim support and continues drifting lower while the dollar strengthens, then we could see a deeper corrective phase. Speaking of the dollar, that's critical here. Silver and gold are priced in US dollars. When the dollar strengthens, metals often face pressure. When the dollar weakens, metals tend to rise. If the Federal Reserve signals tighter policy, or if economic data surprises to the upside, the dollar could strengthen temporarily, weighing on silver. But if inflation remains sticky or growth slows sharply, forcing a more dovish stance, that could weaken the dollar and reignite metals. Now let's talk about something longer term that most short-term traders ignore. The global silver market has been running structural supply deficits for several years. Industrial demand, especially tied to renewable energy and electrification, continues growing. Mine supply has not increased proportionally. That means under the surface, the supply-demand foundation for silver remains supportive. This doesn't prevent volatility, but it does create a long-term floor unless demand collapses dramatically. Now let's address the elephant in the room. Could silver revisit $100? Psychologically, $100 per ounce is a massive level. It's a magnet for speculation. It's a milestone headline number. And earlier in this cycle, silver showed that it's capable of explosive moves when momentum builds. For silver to challenge $100 again, several things likely need to align. Gold must remain strong, the dollar must soften, industrial demand must remain stable, and most importantly, investor confidence must return after this shakeout. If those factors line up, today's drop could end up being remembered as the reset before the breakout. But here's the disciplined perspective. Silver is volatile. It overreacts in both directions. That's part of its personality. Expect sharp rallies. Expect scary pullbacks. That's normal behavior for this metal. The key levels to watch now are simple. First, the recent intraday low from today's crash. If that holds and buyers step in, momentum can rebuild. Second, the previous support zone that broke during the sell-off. If silver reclaims that level and closes above it, that's bullish. Third, watch gold. If gold continues trending higher and silver refuses to follow, that divergence becomes more concerning. But if silver begins catching up, that confirms today's drop was technical. So where is silver likely headed? Short term, expect choppiness and volatility. The market needs to digest this move. Medium term, direction depends heavily on the dollar and Federal Reserve expectations. Long term, structural demand, supply constraints, and monetary uncertainty lean bullish, unless we see a severe global contraction. The most important thing to understand is this: volatility does not equal trend reversal. In fact, silver's biggest historical rallies have often started after violent shakeouts that made traders think the move was over. Right now, the market is emotional. Headlines are loud. Social media is dramatic. But the real signal will come from how price behaves over the next several sessions. Does silver stabilize? Does it reclaim lost ground? Or does selling persist even as gold climbs? That's what we're watching. And remember, when major financial outlets start highlighting deeper monetary concerns behind gold's rally, that's not short-term noise. That suggests bigger macro forces may be in motion. If that narrative gains traction, silver will not stay disconnected forever. So stay alert, stay objective, and don't let one red day convince you the story has ended. Because in the metals market, sometimes the biggest opportunities come right after the scariest candles. If you want daily silver price analysis, silver forecast updates, gold versus silver breakdowns, and real-time precious metals market coverage, make sure you subscribe and turn on notifications. The volatility is just getting started, and the next move could be much bigger than this one. Let me know in the comments. Are you buying this dip, waiting for confirmation, or staying out completely? The next few sessions are going to be critical, and we'll be watching every move.